Hello and welcome to this week's Ferrari Financial Market News Summary. Well, as we predicted last week, this has been a week for consolidation in the markets. The Nasdaq doing quite well, clawing back nearly 100 points by week's end, mainly due to the Federal Reserve injecting more liquidity into the banking system to prop up the ailing credit situation. This was enough to calm investors' nerves and give them the feeling that the gyrations of the markets over the last 3 or 4 weeks were finally coming to an end. Whether or not this will be sustainable will obviously be very interesting to see in the next month or so. But for the time being at least, a little bit of mergers and acquisitions activity this week, plus of course the big news Friday lifting the market nearly 34 points for the Nasdaq, was that the July housing starts were up unexpectedly. Now let's take a look at our chart analysis for the Nasdaq Composite Index. We're going to take a look at the 1-year chart for the Nasdaq Composite Index because I want to focus in more close-up detail on the sell-off feature that we've had since the middle of July, when, as we predicted, the market did top off and has been falling really ever since, except for a small bounce it took off the short-term moving average line, which is this line here, and you can see this little bounce back that happened last week. The Friday rally that we had on the Fed news of cutting 0.5% off the discount rate has brought us back to this level here, but I want to show you 3 scenarios really on the chart. The first is a nice simple one, which is that we would draw a trend line, short-term trend line, cutting through these last 3 points really where the market took a bounce, and you can see how the market has returned each time from the short-term trend line. It attempted to again last week but failed, and the significant penetration down to just under 2,400 indicates to us that the likelihood that the market will continue to follow this trend line upwards is quite low. Our second scenario really is more probable, and that is that we've established probably a barrier range or a channel range between this level here, which is where the market went up to last week before deciding to turn south again, and the level that it bounced back from on Thursday night, which is this level here, which was actually 2,380, and this channel range here is quite a wide trading range that the market could well stay within for the next few weeks. The last scenario is probably the worst of the 3 because even though I don't show it going back a lot further, over the last 3 years a much longer term trend line has been established, which again passes through this point but is a much shallower line, and if I was to extend it back and then forward, extrapolate it to this point here, it would actually touch the scale, the price scale, at around about 2,100. Now we do feel that a right shoulder could be forming here over the next few weeks, maybe within this channel that we've established, and then there could be the inevitable penetration of the 2,400 line that was established this week, and then the next stopping point in our view would probably be down to this trend line here at just over 2,200. So we'll keep a very close watch on the markets in the next few weeks to see which of these scenarios looks like is unfolding, but certainly our best guess at the moment is some more consolidation within the channel line that's been established here, with the possibility of the head and shoulders scenario forming with a right shoulder out here, and then a drop down past the 2,400 down to as low as 2,200. The recent strengthening of the US dollar has also helped give investors confidence that perhaps the American economy is in better shape than at first thought, and also that the Federal Reserve is unlikely to cut interest rates anytime soon. Of course, the markets were looking for an indication from the Federal Reserve that they were likely to cut the Fed funds rate at the next meeting or even before, to give a little bit of support to the general economy. But I think instead the Federal Reserve has decided to stand on the sidelines, ready to inject more liquidity if necessary, and really not to succumb to market pressure to cut the Fed funds rate and make easier cash available to the marketplace. The consolidation period is likely to continue cautiously for a little bit longer, but one point of note is that particularly on Friday, for example, a 34-point rise in the Nasdaq was on very low volume, whereas the sell-offs have been on very, very high volume. This indicates to us that there's no real conviction yet back in this market. So our feeling is still to shed long positions gradually and return to taking some short positions again, as we feel that there's another down leg coming.